Hello everyone and welcome back to the channel. This is Fair Value Finder and today we are taking a look at the most recent earnings for Estee Lauder, Q1 of 2024. Which I know sounds weird, it's November of 2023, but that's how they work. Last quarter they closed out their financial year 2023 and they are already a quarter of the way through 2024 by their financial accounting. So what we're looking at here is the numbers that we had from the last update, which was the year-end 2023 numbers. We got all this filled out. We were looking at a fair value of $211 for the stock, which means a decent place to buy in would be $179. It'd be a bit overvalued around $233, and that was a huge drop from what we had seen previously, $291 at the end of 2022. And that was mostly driven by all of these declines. Revenues down 12%. Earnings per share down 96%, almost cut in half. Shareholders' equity stayed essentially flat. Cash flow was down 15%. They did grow their assets, but their liabilities grew faster, and their dividend growth rate slowed down. So things were just not looking good from 2022 to 2023, and we're going to see if we're starting to see some signs of things turning around and if it might be time to get back in on the stock. Because if they can get back to their 3 to 4 year trends, we would see a much better share price. If they can come in with this guideline here, we'd be looking at a fair value closer to 267, which means a good place to buy in would be 227, and it'd be a little overvalued at 295. And it is currently trading for right around $115, so clearly undervalued. But let's get right into it. I'm going to leave this here. We're going to go look at the earnings report, and I'm going to key this in as we find the stuff so that we can see how things update. And we'd be looking for all of these numbers to be around the 25% mark. So here we have the earnings, and we do see some continued declines. Net sales decreased 10% from what they experienced last year in the same quarter, and their earnings per share was down to 9 cents, which is definitely not on pace for an over $4 on the year. Organic sales declined 11%, adjusted diluted EPS decreased to 11%. They lowered their full year outlook, and they expect some external headwinds. So organic net sales in fragrance and makeup grew, partially offsetting the decline in skincare. Skincare is their largest category, and they have been experiencing a lot of decline there. At least it's somewhat being made up for with some of the other categories. They had a cybersecurity incident back in July of 2023, which cost them 8 cents per share. And they're accelerating and expanding their profit recovery plan to benefit fiscal year 2025 and 2026. So not even really this year. They're just putting the plan in place to, over the next 2 years, grow on the financial front. Nothing too important here. They are paying for the acquisition of Tom Ford. Here we have some details on those categories. So skincare was down 22%, and you can see just how much it makes up, or at least did in 2022. Down quite a bit this year. Makeup up just slightly, still 30% less than what they came in with skincare. Hair care was also down a little bit, 5 or 6%, and in total, net sales were down 11%, going from 3,935 to 3,518. Operating income for these, they did experience a loss on makeup, so although it grew by 1%, they were underwater. Clearly, supply chain and ingredients inflation is impacting that. And hair care, they were underwater last year. This year, they're even more underwater with a 6% decline. So hair care definitely does not seem to be something that we really want to see them grow. It looks like it's a very low margin, potentially loss. So in total, they saw a 93% decline in skincare, a over 100% decline in makeup, a 19% decline in fragrance, and a 83% decline in hair care. And this was for their operating income. Sales-wise, things looked okay, but if they can get their margins back in check, things would be looking a whole lot better. So for skincare, we saw that decrease of 21%. They keep blaming Asia all throughout. They say a decline in Asia travel retail led to a lot of that decline in skincare. It also reflects the pressures of incremental headwinds from a slower than expected recovery of overall prestige beauty in mainland China and the changes in government and retail policies related to unstructured market activity. So that is something to watch. The Chinese government could be a bearish factor here for Estee Lauder. Net sales increased in the Americas due to the Advanced Night Repair franchise. The Ordinary increased with strong double digits globally. I was not aware that Estee Lauder owned The Ordinary. That's actually what a lot of my skincare is. That is something that's good to know. And there were quite a few brands in here that kind of surprised me. I read through all of this here, nothing too important. For cash flows, for the 3 months ended September 30th, 2023, net cash flows used for operating activities was $408 million compared to $650 million in the prior year. This reflects lower levels of working capital, partially offset by lowering earnings before tax, excluding non-cash items. But capital expenditures increased to $295 million from $152 million in the prior year, primarily due to the timing of payments related to the construction of the manufacturing facility in Japan. So that's a decent capital expense. They're anticipating to progressively improve their performance through the second half of 2024. So they're not even banking a whole lot on this next quarter, Q2. And then for that 2025 and 2026 profit recovery plan, they're hoping to drive an extra $800 million to $1 billion of incremental operating profit through the initiatives of that plan. Next quarter, they're hoping to have between 47 and 57 cents in EPS. For the entire year, though, they're looking at 208 to 235. So on our sheet, we had 483. Analysts are expecting 362, and Estee Lauder themselves are saying 235. So there is a large gap in these numbers. We're going to go with hopefully the higher end of Estee Lauder's numbers. So updating that to 235, right off the bat, knocked down our fair value of the stock to 202. So if that's the case, they are still on the decline. So for net sales, there was a 10% decline. They came in at 3,518. And last year they came in at 3,930. That takes them 21% of the way to our $16.7 billion goal. So if they are going to step it up in this latter half of the year, they could hit the goal. But right now they are coming in a bit shy. A gross profit, 2,488. 16% decline from what they experienced last year. We're seeing declines continue. And the fact that the gross profit had a larger decline than the sales, we do see how inflation is impacting them and how the cost of goods is on the rise. So it looks like with those numbers, cost of goods is actually right where we would expect it to be if they were on track for the revenue goal, 25%. But gross profit is at 20%. So they're running at a worse gross profit, a worse pace for gross profit than they are for revenue. And that comes out to a gross margin right about 70%. We'd really like to see that at 75. 2023, they were at 76, 22, 75. 21, 76, 2020, 75, 2019, 77. So they definitely have it in them to be in the upper 70s. Total expenses, 2,350, an increase of 5%. That's definitely not what we want to see from a company that is on the decline. And that is giving us expenses as a portion of revenue of 66.8. So they're running light on expenses. That's coming in at 16% of goal. Expenses as a portion of revenue, They are running light on that as well. Traditionally, they've been in the more 80% range, and they're only coming in at that almost 67%. So things are looking decent there. Net profit. Something to note here is how the interest expense doubled here, 46 to 95. Interest expense and investment income doubled, 15 to 41. And then other components of net periodic benefit cost shrank a little bit. EBIT, they came in 93% less than they experienced last year at 46 compared to 633. So that definitely is not a good number. And then for net earnings, we come down to shareholders, 31, down 94% from last year. So they're coming in with a net profit of very little, a net percentage of less than 1%. So they definitely need to take a look at those margins and fix them, because that's not a way that a company like this can survive. And then earnings per share, they came in at 9 cents. So they're 4% of the way to their goal for the year. I really don't think they're hitting 235. We'll see how they're able to turn things around come the latter half of the year, as they've discussed. But it's not looking too good for that at the moment. Basic shares. This is something I did notice is they started to issue shares again. They went from last year 357.9 to 358.4. So things have definitely gotten a little rough. They had traditionally bought back shares. So it is something to keep an eye on. Hopefully it's just a small little thing, get some cash to help handle things, but we'll see as time goes on. Shareholders' equity will be down on the balance sheet. Okay. Then we have the balance sheet here. Their assets are up from last year at the same time, but down from last quarter. So we see cash and cash equivalents makes up quite a bit of it. Also property, plant, and equipment, and then other assets. Those are the big three here. So their assets come in at 226,501. 86% of goal. We'd want to see that reach 26 by the end of the year. And sitting at 22, quarter of the way through the year, I'm not sure that they're going to hit that, but we'll see. Liabilities, at least this is declining as well with the assets. It is up from where they sat last year, 5.27 to 5.91, but down from the 6.24 that they had last quarter. So we'll see how that affects them. It does look like they are working on paying that down. We saw the interest expenses were very high, so it's probably a wise decision for them to be doing. It's a number they've traditionally grown. They haven't been great at paying that down, and that's probably one of my largest issues with the company is they do have a very high debt to equity ratio. They've had it as high as 3.5 in 2020. It dropped down to 2.5, and then it's been on the rise since. It went from 2.47 to 2.59 to 2.87. And then the shareholders' equity down here is declining. It's lower than it was last year and last quarter. Definitely does not help with that metric. And for that, they're 90% of the way to the goal. So they do need to grow at another 10% to hit what we'd really be looking for there. And then for cash flows, looks like they spend a lot of money in Q1. Both last year and this year are negative. So I'm not sure that's a huge concern, because last year they came in at 1.7 at the end of the year, having started off with negative 650. So if that's the case, they might be able to do even better this year. We'll see how things go. And that's it for the earnings report. So we'll flip back over to the sheet and we'll look at the updated numbers. And here we have them. So they're running shy of goal on revenues, on gross profit. Expenses, that's a good thing. So they're ahead of goal. Net profit, they're definitely shy of their goal. And EPS, clearly shy of the goal. Share count's trending the wrong direction. Liabilities are getting too close. It looks like they're going to break above their typical liability growth of 3 to 5%. They had done a decent job at not growing it as quickly after a huge jump from 2019 to 2020. But we'll have to see how things pan out. When we go back to the balance sheet, we see that their current liabilities are about a third of their total. So essentially, this current debt here will help drive that down unless they need to take out more debt, and then potentially some of this accrued liabilities as well. Accounts payable, that is a fluctuating number. It'll change by the second at such a large company, and their lease liabilities. There's nothing that they can change about that. So with all of that, this is what we're looking at. So we are looking at continued declines for the company. 172 would be the buy-in price if this is the floor. I would really want to see how the next quarter plays out and see when they start these initiatives, how things go. And keep an eye on the stock. If it gets up to 150, I might get some interest on taking up a little bit of a position. If 172 is my potential buy price, and it currently sits at 115, so it'd take quite a bit for that 30% jump back up to 150, and would definitely be a time to dig back in deeper on the stock. I really don't see them hitting this EPS with how they started out the year. It might come back in closer to that $2 that they had said. It was in the low $2 range. It's like 2.08, and that would drop down the valuation even lower, under 200, which would make 166 our price of interest. So what I'm looking for the next quarter, get closer to the goal on revenues, drive up that profit margin for the net, honestly the gross as well. They got about 4%, 5% that they are, and then cut costs. It looks like there was just some accounting that went into play to alter this net profit, because they came in decent on their expenses as a portion of revenue, but then it dropped way down after that. And it was almost entirely from that interest expense that had doubled on them. This is an interesting one. We'll keep an eye on it. I own like $5 I threw in there because the price was so low, and honestly I might throw another 5 down just because I want to keep it on my radar. But it'd be a turnaround play if anything. If you look at the long-term trends here, the revenue growth does not look good. The debt to equity is not trending in the right direction. The shareholders' equity itself is not trending in the right direction. The free cash flow, there's a lot of negatives here. There was a huge boost in 2021, and they've kind of just been dropping since there. Now, the dividend is all right. If they're going to come in super low on earnings, if they're only going to hit 208, they're paying out 284 in dividends. They're underwater. So they'll just continue to hemorrhage money. And so I don't know if that is safe if they do continue on the track that they're on. But that's what we're looking at for the stock. I'd say be careful with it. Keep an eye on it. It's interesting as a turnaround play, not really a long-term investment. But my interest is peaked on it. So I want to thank you guys for watching. Please like if you enjoyed the video. Comment what other stocks we should take a look at and subscribe so you can stay up to date with everything. And I'll catch you next time.